This episode is brought to you by Vonage. Your business needs more than an 800 number. With Vonage Voice API, you can provide the call experience your customers expect and get the data your team needs. From call analytics and virtual assistants to automatic speech recognition and text-to-speech in multiple languages, your customer service team can help more people in more places. And with in-app voice, your customers can easily contact you the moment they have a question. Take your calls to the next level with Vonage Voice API. Learn more at Vonage.com.
Do you know how much your wireless is costing you? Probably a lot more than you think. But with Consumer Cellular, you can get talk, text, and data for just $20 a month. Consumer Cellular also offers flexible plans, nationwide coverage to 99% of the U.S. population, no contract, and a 30-day risk-free guarantee. Plus, you keep your number and your phone. Make the switch today. Go to consumercellular.com to get started.
This is Optimal Finance Daily, episode 2284, Why You Can't Become Rich Without Debt, by Chris Odegard of theprolificinvestor.net. And I'm your host and personal finance enthusiast, Diana Merriam, welcoming you to another Monday Mastery episode here on Optimal Finance Daily, where each Monday we take a look at an article that delves especially deep into personal finance and challenges you in new ways. So with that, put on your thinking cap as we get into this next article and start optimizing your life. Why You Can't Become Rich Without Debt, by Chris Odegard of theprolificinvestor.net. Today's topic is why you can't become rich without debt. But first, why do we invest? We invest so that someday work is a choice instead of a necessity. And when we reach that point, whatever we choose to do revolves around what fulfills us and makes us happy, instead of what produces the most income. In order to get to this destination, however, we have to acquire and grow assets so they can produce the income to support our lifestyle. But before our assets actually grow, they have to outpace two significant obstacles: inflation and taxes. If our assets don't outpace inflation and taxes, the dollars they produce won't maintain their buying power. In other words, when we get to that magical place where we don't have to work anymore, we find that we can't maintain the lifestyle we had when we were working because our dollars won't buy the same amount of stuff. So here's an interesting question. What's the required annual return on our investments, ROI, just to keep pace with inflation and taxes? If we're all striving to retire someday, shouldn't we all know the answer to this question? Buried deep within the code of Quicken Financial Planner is a formula called the break-even rate, sometimes called the break-even return or ratio. Using this formula, if the real inflation rate is 6% and the combined effect of federal and state taxes is 40%, every investment in your portfolio needs to achieve a 10% ROI every year just so your money keeps pace with inflation and taxes. If your investments aren't performing to this level, you're losing financial ground. Some of you are going to ask, Chris, why did you use 6% inflation when the government says it's around 3%? Simple, the government is lying. The variables in the break-even rate formula are investment performance, federal and state taxes, and inflation. Number 1, investment performance. At first glance, one might say the only variable we can control is investment performance. Typically, that's exactly what investors do. They chase higher performance, also known as yield or ROI. This chasing of yield usually results in riskier investments, which often work against the investor and actually produce lower yields or losses, just the opposite of what was intended. Number 2, federal and state taxes. As far as taxes go, the sophisticated investor can reduce or even eliminate taxes, but that's beyond the scope of this article. So let's assume for now we can't do much about taxes. And number 3, inflation. Now we're just left with inflation. There's nothing we can do about that, right? Well, we can't control it, but we can pass a portion of it on to someone else. If you purchased a home with a fixed rate loan, you passed a whole bunch of inflation risk onto the bank. If your house costs $100,000 and you put $20,000 down, the bank loaned you $80,000 in today's dollars and will receive it back over the next 30 years in dollars that are declining in value each and every year. That's a great deal for you. That bank is now carrying the inflation risk on $80,000. In the prior example, with inflation at 6% and federal and state taxes totaling 40%, our investments needed to earn 10% just to keep pace with inflation and taxes. If, when we invest, instead of investing with 100% of our money, we invest 20% of our money and borrow the remaining 80%, just like when we bought our home, the break-even rate goes from 10% to 2%. This means our investments only have to earn 2% to keep pace with inflation and taxes. And you did all this without taking on any additional risk, provided you got the right amount and type of debt to match the asset. You see, the inflation rate in the formula only affects the cash you invest, not money you borrow at a fixed interest rate to invest. This is why you can't become rich without debt. In fact, you barely break even without debt. There are some very popular and successful people out there telling you that you need to get out of debt, but they're only telling you part of the story. The rest of the story is that there is good debt and bad debt. Bad debt can lead you to financial ruin, and good debt can make you rich. If you've racked up a bunch of credit card and other consumer debt buying, you need to pay off that debt. But once you've done that, you need to use good debt to buy assets. That good debt will, at minimum, preserve your lifestyle in retirement. And if you desire to be rich or build generational wealth, good debt is the only way to get there. You just listened to the post titled, "Why You Can't Become Rich Without Debt" by Chris Odegard of theprolificinvestor.net.
It's easy to grow more vibrant plants. Just feed them with Miracle Grow Shake and Feed. Shake a little around your plants once every 3 months and you're good. That's all you need to know. Not even sure what to talk about for the rest of this commercial. I guess I could list off my favourite plants. The weeping fig, honeysuckles, any kind of fern, I'm a sucker for a fern. Spider plants, roses, classic. Oh wait, I forgot to have to say the slogan too. Miracle Grow, all you need to know to grow.
This episode is brought to you by Circle. Digital currency is helping to form the base layer for a new global commerce infrastructure. And stable coins like USDC issued by Circle help to bring faster payments at internet scale. From merchants at the point of sale to corporations that want to pay global suppliers and even employees, it's all done more efficiently. Visit circle.com/Spotify to learn more.
While I agree with Chris that it would be challenging to invest in a real estate portfolio without debt, you can absolutely reach financial freedom without investing in the stock market on margin. When you hear about people who lost everything in 2000 or 2008, a lot of the time they were investing in the highest flying and most risky growth stocks. And more importantly, they were borrowing on margin to do it. The lesson here is that if you borrow money to invest, you are multiplying your risk and could lose all of your money and more. And this does happen with real estate as well. Think about how many people were underwater on their mortgages after 2008. This did not and will not happen to you if you're invested in low-cost, broad-based index funds over a long period of time. In essence, you can handle stock market risk if you don't multiply it. Further, if you're investing in tax-advantaged accounts like your 401k or IRAs, your real rate of return is going to be much closer to your nominal rate of return due to the tax benefits of these accounts. I don't know anyone who is paying 40% on their investment returns across federal and state taxes. The capital gains tax rate is 0, 15, or 20% on most assets held for longer than a year, and state capital gains taxes range from 0 all the way up to 13.3% in California. Chris's argument on needing over 10% ROI to break even as a justification to invest on margin seems to be based on investments held for less than a year by someone in the highest tax brackets. And in terms of inflation, your personal rate of inflation could be much lower than the national average, especially if you don't buy what you don't need and you're willing to substitute with less expensive alternatives. For example, yes, grocery prices have gone up, but I'm still able to consistently find meat on sale for around $3 a pound. I have to be flexible on the meat I buy week to week, but I'm not spending any more than I was before inflation increased. I make these points because I think Chris's rationale on why you need to invest on margin is inflated. You can absolutely reach your financial goals by spending less than you earn and investing the difference in total market index funds. It's certainly working for me. But that'll do it for this episode. Have a happy rest of your day, and I'll be back with you again tomorrow, where your optimal life awaits.